Marvelous year, everyone. Let's take a look at what happened and what could be happening going forward. So let's look at this last year. Let's begin with January. January was the start of the new administration, and while I'll have a more thorough written version of this report on Substack, to summarize what I think can be summarized quite succinctly, we learned that this was going to be a quite serious change. Now, right now, you have one chunk of the country that is screaming that the end is nigh, and that this is the worst, most oppressive dictatorship to ever exist. And then you have another chunk saying it's business as usual, he's not going fast enough, go harder. But if people could step back from their emotions for a moment, it is quite clear that this is a very fundamental change to the administrative state. And that manifested very early on in the sweep of executive orders. But additionally, how much began to be challenged in the courts. And this not only demonstrated an administrative change, but quite quickly signaled that the role of judges, how the judicial system operates as a whole, could very well be changing into a new order. I don't know what the ultimate resolution will be, but it is quite clear that this is a reordering of the structure of the state. February gave us the LBMA crisis, when time for delivery on precious metals in the London market began to take months. This was a very powerful story, yet one that was really only known within financial markets. This wasn't something that ever really got big with the public. However, I think it should have, as what was ultimately being signaled is that the power of the London bullion banks and the commodities pricing mechanism that had for a long time dominated the world was breaking down. This showed tremendous weakness on the part of the LBMA. I mean, these London banks have dominated the metals market for centuries. And now to see them unable to make these deliveries, and to see just how strained their credit became, that was a very powerful signal. One, of their own weakness, but two, that in the face of a fundamental global reordering, one where central banks are buying gold, one where the US and China are buying gold, and one where the big players like the US, Russia, or China, and the commodity producers as a whole, are fundamentally rejecting the pricing regime that has dominated the world. That there is a powerful sovereignty movement across the world. This is the commodity nations saying no, we won't be bound by the Europeans, and that they won't be subject to the financial order as it has been. There's certainly a geopolitical risk hedging going on, but we are seeing a return of gold into the monetary system. We're seeing countries begin to question the credit that has dominated the world. This is a very profound rejection of the Anglo-American financial order. And though many people have said this is de-dollarization, it really isn't. It would be de-dollarization if we were seeing the US dollar simply stop being used. But we haven't seen that at all. We saw, on the one hand, every currency drop in relation to gold. Yet more than that, in many regards, we have been seeing re-dollarization, with changes in dollar rates concomitant with the usage of dollars. Let's look at stablecoins as well. We're seeing entirely new markets for dollars. And when one points to something like the Chinese selling off US treasuries as a reserve asset, they've been selling off credit assets as a whole. And they've been doing so steadily. Not in any way that's indicative of, oh no, this thing's worthless. Instead, it's much more fundamental. It is a change away from the London credit asset-based system. The credit asset-based system and the pricing mechanisms of London, and a shift toward real hard assets playing a fundamental role in the global monetary system once again. Not only is this recollateralizing the global system, but it is taking a very profound power away from the London banks. The power of influence over the commodities markets. In fact, in just the past few weeks, the Indians have stopped using LBMA price benchmarking for their gold. And all of this really began in force in February, when we saw that the LBMA just could not handle the changes. In March, we saw a great deal of fighting in the courts. This was a very strong signal because on the one hand, it demonstrated just how deep this fight between the factions was going to be. And by factions, I don't mean parties. There certainly is correlation with parties, but I mean power factions, like the actual factions of power. But more than that, it signaled that the administration was trying to do something more than simply get actions through. There were plenty of ways they could have ignored the courts. There were plenty of ways they could have just rammed things on through, but they didn't do that. And though at the beginning there were many of the base who were screaming that they should simply ignore activist judges, they didn't. And later it became quite evident why. They were using a much different strategy. They fundamentally wanted to restate the powers of the Article 2 executive. Over the past several decades, many of the powers of the executive have been handed off to the judiciary and the legislature, while the legislature has given their powers up to the executive, and so on. To a great extent, this has been returning to the table and saying, alright, who has what powers? We'll settle it now. And this also means that in the future, it will be much more clear and much more justified should there be some major move that the White House wishes to make. In April, we saw the economy collapse. We saw everything sell off and inflation hit 2 billion%. Because the whole world is based on free trade, and tariffs destroyed the world. The story of the tariff panic was some of the most wild alarmism I've ever seen. And what's really striking to me is that there were really quite skilled financial professionals who were panicked. There was a very good global equities manager that I heard a report from, and he was giving a presentation internally to another quite high-level financial firm. And he was convinced that this was going to be absolutely awful, and we'd see enormous inflation and everything would break down. This is indoctrination, and I'll say it, this is unthinking. It's actually pretty obvious why that inflation mechanism wouldn't happen. Why? Because no new dollars were made. In fact, if anything, closing that persistent trade deficit would mean that the outflow of US dollar and US dollar assets would create a smaller base to be rehypothecated in the Eurodollar credit banks that have much looser rehypothecation standards than the US. If anything, it could contract the dollar supply. But alright, I'll take the point certainly that we might see some prices rise. But that alarmism was really just ridiculous. And I certainly understand that there were a good chunk of people who are quite invested in trade barriers as tariffs not being in place. It works against their interests, so of course they'd have to tell the most alarmist story possible. But for people who are trying to analyze it impartially, particularly people who should know better, that panic was wild. First of all, the entire world has operated off of a system of tariffs the entire time. This post-war order of the US has no restrictions, and the rest of the world wedges open trade surpluses that should be arbed away under the actual theories of the economics that the institutions use, where other countries have enormous trade restrictions not only from things like tariffs, but from regulations. And ultimately, the US subsidizes the rest of the planet. This system isn't anything like what one would think the words free trade means. This is extremely manipulated trade, and in a world where the US constantly supplies foreign banks with the underlying assets to print new dollars, it's really just set up a world where the US is a consumer base that continues to buy and buy goods with lower and lower purchasing power. Yes, certainly we could see things like TVs getting marginally more expensive. But empirically, the last time we saw trade barriers like this, it did not have those enormous, massive price increases. And that's because companies can't just pass them on entirely to consumers. But more than that, the absence of that outflow of dollars, the absence of that permanent differential, and the absence of that purchasing power draining mechanism creates a net effect where the purchasing power of Americans is more stabilized than in the past. So of course that alarm situation was not going to happen. And businesses knew that they weren't going to be able to pass these things on entirely. Yet still, the market sold off in a panic. And propagandists from Europe began pitching stories like, well, no one believes in the treasury anymore. Everyone's flocking to the safe haven of the German Bund. Categorically untrue. But there was an odd situation occurring, where on the one hand there were people who were very scared genuinely, very often not knowing what was going on. But to a large part, there were people who were very intelligent, but were just so deeply in the language game of free trade versus whatever the boogeyman they imagine is. It's free trade versus socialism, or free trade versus communism. Free trade or no trade. It's more of a language construction where they imagine that free trade is the thing that maximizes the goodness. And yet, in an abstract sense, the total economic output of the planet might be maximized if everyone had no trade barriers. But that wasn't even what was happening to begin with, and even if it were, it would create countries that are just not functional. No, this is a reordering of something that's much more fundamental. And that's where the second class comes in, because there were many people who did understand exactly what was happening, and they were creating propaganda. They were intentionally making people afraid, because there are many very powerful people who have depended on these mechanisms for their own wealth, for their own power. So the propaganda was immense. What this month told us is that the economic fight was real, and that the deeply entrenched powers were, one, deeply entrenched, and two, powers. We learned just how real the fight is, how high the stakes are, and just how panicky capital markets can be. In May, we really saw this play out and become more of what was termed a trade war. And at that time, many of the narratives were there were going to be these enormous tariffs for forever, presumably. This was another very odd media moment, as if anyone had ever actually listened to the guy talk at any point in the last few years, they would have heard over and over and over and over, I'm very happy to have these tariffs come down quite low as long as we can get new trade deals. So the bet was quite simple. Would there be more trade deals? Many people immediately looked to China, assuming that this would be a US v China fight. And of course, the big boys all had to come out saber-rattling, but a lot of that was just for domestic consumption. Of course, Donald Trump has to say that he's the best deal maker who's ever made deals, and that the Chinese are just going to roll over, while the Chinese have to say that the Americans have nothing. China number one. But this was just for domestic audiences. They had to say that. And by this point, it was becoming quite evident that if one looked on a deeper level, the global reordering was not a US v China conflict. On the contrary, the US appeared to be giving more latitude to the Chinese to become hegemons of their own region, respecting them as their own sphere of influence and power. And one thing that was brewing that was, of course, known within Brussels, and known within a great deal of DC, but somehow again appeared to be ignored by everyone, was that the real fight brewing was the US versus Europe. And that began to become evident as the trade deal with the EU became more of the story. June was the war with Iran. The good old less than 2-week long war. This one I still think is very misunderstood. Now, of course, I don't have all the inside information, so I can't say exactly what happened. But I have what I think is a reasonable analysis. And it's certainly one that squares a lot more with what actually happened than many of the more sensational theories that are out there. Immediately as conflict between Israel and Iran ramped up, all on the back of the US attempting to secure a deal with the Iranians vis-a-vis their nuclear program, the US exploded in panic, with commentators swearing up and down that we were just about to invade Iran for regime change. The stories were out in force, that the Zionist lobby just had so much power that they had forced the White House to finally do what the Likud had always wanted. Aha! I knew that Donald Trump pulling the chair out for Benjamin Netanyahu meant that we were going to go to war with Iran. There will be an invasion tomorrow. Get ready for the draft. What happened was very different. One, it looks quite evident at this point that there was a lot more communication between the US and Iran over that period than was evident at the time. So the US runs strikes, all the while Israel and Iran waste their ammunition. What actually happens? Well, the US strikes something, and then President Trump comes out and says, Iran no longer has a nuclear program, and the war ends. So one could assume that this was exactly what the Israelis wanted and they had forced his hand. Or perhaps he has always been beholden to the Zionists. But this is not what Israel wanted, and the neocons were irate. You had neocons coming out immediately after saying, no, you didn't actually get the nuclear sites. We have to do it again. We have to send troops. We's gonna send them little boys in their tight pants. This was not what any of them wanted. This was not regime change. This was not a war. What happened is there were superficial strikes, and then it was off the table. The entire justification, the casus belli itself, was gone. And were the sites actually destroyed? Probably not. But the entire narrative was destroyed. Now one could assume that this was Donald Trump acting on behalf of the Likud. Sure, in which case he did not accomplish what they wanted. superficial strikes and showing them that there was actually no point to what they were doing, that didn't do anything for them. Or one could assume that what he had been saying the entire time, that he wanted to end these forever conflicts and allow the region to stabilize under its own self-interests and rule, might actually be true. Because what was the forever war in the Middle East? It was the constant threat of Iran almost has nukes. It's been that for years. That was the constant war footing. That was the always present casus belli. And suddenly it was gone. He had forced Israel and Iran to show their hands and to show that they really could not do the war that they wanted. And in Iran, there was no regime change. But at the same time, the non-state actor groups like Hamas and Hezbollah became shadows of themselves. And the internals in Iran actually matter because there are a great many factions that have all vied for the direction of the country and they don't all agree. Yet the theocracy was able to stay in power. And now the impetus for war was gone. The motivation for war was gone. And sure, you still had Zionists and neocons coming out and saying, we didn't finish them off, now we have to do a bigger war. But that was just untenable. The justification could not be made. Because once the story was we struck their sights, there was absolutely no possible way to make the justification. It was taken off the table, Iran and Israel showed their hands, and at least for now, the forever war was taken offline. This shows us that these forever conflicts are based on stories that must be constantly watered. And yet, if one ever really presses on them, they collapse. The constant actors behind the constant agitation for war footing don't actually have the strength that they appear to. And we learn that perhaps, just perhaps, there might be a way forward, and one that isn't going to require drafts or nuclear war. In July, we saw deportations ramp up, and we saw, following an ICE raid on a money laundering operation, an enormous wave of protests and riots, particularly in Los Angeles. We would see the National Guard be employed, which would of course then go to the courts. Although it would become quite clear that this is a valid use for the National Guard within our legal system. This showed a few things. One, it showed that groups such as those protesters and rioters could still be quite easily spurred on. And two, it showed that someone was really agitated by that raid on the money laundering facility. Ultimately, it showed that the internal conflict had more legs than it may have appeared to in the months before, showing that those groups could indeed still be spurred and that there would be enough people. It became clear that the power factions, and I don't mean left and right, I don't mean Democrats and Republicans, I mean this in the nicest way possible, but the sides that most people think of, yeah, not the ones that are made for mass consumption. I mean the actual power factions. Those actual power factions showed a true willingness to go kinetic. And going forward, that taught us that that is something that we have to be mindful of. That this conflict over the future of the United States and the global order at large could have very real, on-the-ground, tangible effects in the country. In August, we saw the Alaska Summit. This was a very interesting one. And while people generally recognize its significance, particularly for the developments vis-a-vis the Russo-Ukrainian war, there was also something that was perhaps symbolically very powerful. Vladimir Putin came to Alaska. What would happen if he tried to go anywhere in Europe? Could he go to London? Could he go to Paris? Frankfurt? Brussels? No. No, if he tried to go anywhere in Europe, he would probably be either shot out of the sky or imprisoned. But he can go to Alaska, and that proved something. It was quite evident that the Americans and the Russians were interested in trying to find a resolution in a way that the Europeans are not. And that's been quite clear for some time. But the fact that Putin was physically able to go to the United States shows something else. It shows that the fundamental relationship between the US and Russia is not the same relationship between Europe and Russia. It shows that in the scope of the Russo-Ukrainian war, and in the global order as a whole, the United States-Russia relationship is not the same as the liberal, rules-based order and its relationship with Russia. And that is very big with some very big implications. And as we would see in the following months, particularly after the idea of the Core 5, an international group of the US, Russia, China, Japan, and India, that the US has an interest in a reasonable relationship with the Russians in a way that Europe doesn't, and that the US is willing to just go ahead and leave the Europeans behind, that the US will say no to the Europeans, and particularly on the back of all the financial conflict, on the trade fight, and increasing fights over things like domestic policing and speech laws, that maybe the US-Europe deep alliance was going away. That's a thesis that I had had for quite some time, and something that looks certain now. Yet at the time, Putin going to Alaska when he couldn't go to Europe was maybe the most powerful symbolic moment of that shift to date. I was thinking, this channel is fundamentally about investing, about capital markets, yet it touches so many things. It goes into history and philosophy, global geopolitics, diplomacy, law and domestic affairs. It talks about commodities as much as it does talk about the current events. Why is that? What makes this what it is? Why is that entangled with finance and markets? Shouldn't it be that a financial channel doesn't have to talk about geopolitical entanglements? It's a really interesting question, particularly in our modern age. And ultimately the answer is, of course, they must all be understood if somebody wants to invest, particularly in this style. Particularly if somebody is using a more macro style, one that involves different currencies and countries and commodities. The history, the politics, the philosophy, it all has to be understood. And that's because they're all very deeply intertwined. I'm very interested in religions and history, but I didn't mean to make this anything other than a financial channel that sometimes talks about music theory. But I have to talk about all of them, because ultimately, particularly in this more macro style, what we have to analyze is the machinery of the world itself. The machinery of our modern world, the underlying mechanism is the financial system. The fuel of our modern world, of our governments and ordering, is the monetary system. The ruling powers ultimately include, of course, militaries and intelligence. But at the deepest, it's the banks. What we're doing here ultimately isn't studying finance or markets. We're studying the system as a whole. And for that, understanding what silver futures prices just did is ultimately just as integral a part as what a religion 500 years ago said. Perhaps the religion is even more significant, because we're understanding the machine itself. And that's really significant for September. In September, we learned a lot from the death of Charlie Kirk. That assassination very fundamentally changed a great many things. Many of the assumptions that the civilization has been operating under. We learned that it's real. We learned that it's escalating. And many said, no more, we can't live like this. While there were many people who cheered it and wanted more and more escalation. We learned that it's real and it has reached that place. Now one might say no, and come up with different explanations as to who killed him. But to a great extent it doesn't matter who killed him. It could very well be this one weird kid, or it could be an intelligence agency. It could be a foreign government, or it could have been people that he worked with. In many ways, the official story actually isn't that much different functionally from if it were the most dissident, radical, wacky theory. Because who killed him? They killed him. And that actually means more than it seems like. They. Who is they? Perhaps they is emergent. We learned that the situation is very real. We learned that there are very real consequences. And we learned that there is serious conflict. That things could get really bad. They is the force that did this. They is the force that has emerged. They is all of those people who cheered. They is the system that led to this point. They is very much those power factions. The sorts of people one might imagine when they imagine shadowy intelligence agencies. Ones who would do some sort of clandestine hit. But they is also someone who is radicalized. Someone who was deeply afraid and angered because of the propaganda and the wrath and the fear. They is what has emerged from all of this. They is where the system is at this point. They is the erosion of the system and the desperate flailing to save it. They is the fight against time. They is fear. They is wrath. And they is envy. And they did this. We learn that it's very real. And we learn that going forward, the conflict must be taken very, very seriously. So what does this have to do with financial markets? How can you trade off this? Well, you probably can't trade off of this isolated event itself. But if you know that this is the current state, if you know that this is where the psychology of people in the civilization is, if you know how very real the conflict is, how very real the desperation of the players involved is, if you know that this can happen, then you will take very seriously different potentialities than you would otherwise. And that's what we learned ultimately. Take it seriously. And that the sorts of things that we never would have imagined possible only years ago could very, very well happen. In October, we saw a fight over the government shutdown. This was very curious, and I haven't quite figured out exactly what the strategies of the players were. At the same time, there was movement going through the legislature, both on the front of Fannie Mae and Freddie Mac, as well as for stablecoin legislation. At the same time, there was still a continuation of the fight over the size of the federal workforce, with an effort to shrink the administrative state. So there were some real pivotal points for some very real conflict. A fight of the global financial order and the administrative state, fighting to fend off the moves being made by the new administration. So it would certainly make sense to try to stymie these actions, particularly for if the mortgage market changes, where the financing needs of America's middle class becomes what drives U.S. credit markets, and particularly in light of the shift to SOFR, then foreign financial interests could stand to lose a lot of power in terms of their influence over the long end of the yield curve. Stablecoins as well could pose a real threat to other currencies, and for the perpetual debt and tax model as it has existed, the model that we have talked about many times in the videos. Yet it quite curiously wouldn't help the case of the administrative state trying to defend itself, as a protracted shutdown could offer an opportunity to lay off more of the workforce. So there are a number of interests that could have all converged here. At the same time, there was an opportunity to attempt to force the hand of the executive, particularly using military pay and SNAP benefits as leverage points. Now, as per always, the PR of a shutdown is never great for Republicans, but something quite curious happened. They did a whole lot better than usual, and a whole lot more blame was given to Democrats than had historically really ever happened. Ultimately, this was quite costly for the Democrats, yet considering the risks of some of the financial legislation that was in the works, it may have been necessary for some of the power factions behind them. And the administration found a way around some of those issues quite well, particularly finding private funding for military pay. But something that we can learn is that it's quite likely that there will be future gridlock. But it does also indicate that it could be quite tactical, as there had to be much that was given up in order to execute this for that length of time. So certainly something had to have been gained, and perhaps it was worth it. Perhaps that was the necessary move. But it does show some much more powerful PR on the part of the Republicans right now, at least better than it has been historically. And it shows that this sort of protracted gridlock could continue, but could very well be for tactical purposes. This shows us that we should probably watch what legislation is going on in the background, what fights are going on in the background, and then from there might get a better sense of what the tactics are, both in the PR arena and in attempting to deny the other factions. November showed us the new Monroe Doctrine. This is really interesting. We have a lot converging here. One of the earlier things we saw was the movement of the Ford carrier group out of the Mediterranean and into the Caribbean. This is a very interesting group of ships, as this carrier group had, for the past while, been acting as implied muscle for the Israelis, an indication of American backing. Yet it was pulled. And at the same time, when entering the Caribbean, it was able to act as a show of force, but also had very strong signals intelligence capability. What we heard out of the government was that it was going to counter smuggling operations through the Caribbean. Now, there's a lot of power in these routes. One, just the great financial power that exists within these organized crime networks, but also a great degree of geopolitical power, as these non-state actors have quite powerful backing across South America, Europe, and to an extent Asia. And those smuggling routes also touch money laundering hubs, so having SIGINT present is a very good tactic if you wanted to go after them. Yet one immediate question raised is why the focus on Venezuela, as that country isn't itself a hub of these criminal routes. However, it is a hub of non-state actors, and beyond that, there were some moves being made at the time. It became quite evident that the ruling factions of Europe wanted the opposition, led by Machado, to be propped up. And in fact, for a long time, going back to the first Trump term, there had been very clear indication of the neocon warhawks wanting Maduro out. So it's very clearly an important tactical position. So we have smugglers, we have the tactics of Venezuela, and now we have murmurings of regime change, although at present only through soft power. At the same time, we have Chinese presence, and over the following weeks, something that became quite evident is that the Trump administration was quite happy to leave Pacific areas to the Chinese, respecting their sphere of influence and control, yet demanding respect that the Western Hemisphere be America's. A very imaginable scenario is one where the U.S. Navy applies further pressure on the smuggling routes and attempts to stop these non-state actors' organized crime, yet may be content to leave Maduro in, as those who are truly backing Machado seem to be European. Now, does that mean the administration likes Maduro? No, not necessarily, but might see him as a perfectly viable puppet, non-sovereign actor. You can keep the office, but I'm the new boss. People have tried to pin down exactly what these moves have been, and it's very possible that these are all different moves dealing with different things, yet they all converge around the same location, as that is the geostrategic nexus of the Americas. And if the administration truly wants to assert the Monroe Doctrine, then that is exactly where you would apply pressure and show force. That's where you might see blue-on-blue action. And by the end of the month, it became quite clear that the Trump corollary to the Monroe Doctrine, or the Trump corollary to the Roosevelt corollary to the Monroe Doctrine, will be a very real and present geostrategic force that must be understood. And in December, we get some interesting money news. We see rates get really high in Japan, with the 10-year cracking above 2%. And at the same time, we see a fight emerging over what to do with the Russian assets that have been frozen in Euroclear. Many in Europe seem to really want to just take those Russian assets. Yet ultimately the argument against it won out, as that would substantially undermine respect of the European financial system. Yet, looking at the actions, particularly out of Germany and France, it looks like they may have actually been using those assets anyway. Even if not directly using them, acting as though they already had them, assuming a larger pool of collateral, or making guarantees. And when the seizure lost out, talk of centralizing fiscal power in the EU escalated. Give the EU tax and spend authority and centralize debts. All of that is to quite evidently say, Europe is in a pickle. And at the same time, low-yielding Japanese credit stopped being the carry trade asset that it had functioned as for a very long time. The effect of that is to drain out quite a lot of leverage out of the system. And Europe is one major player who has made use of the Japanese carry trade heavily. So this is a financial squeeze on multiple ends, and I would particularly pay attention to where cracks begin to form as a reflection of the loss of the Japanese carry trade, as there could be a whole lot of positions that no longer are sustainable. I haven't fundamentally changed my thoughts on equity factors and regions, but am now giving a little bit more thought to US small and emerging market value. Both of them I have as a lighter color, as I'm still keeping my overall position in the same place, but indicating that they might be leaning that way. I might be a little bit more bullish on US small and a little bit more neutral on emerging market value. And the reason for that in the US is the valuations, as well as recent economic data. Economic data has shown pretty good growth, and right now energy costs are extremely low. Additionally, for all the talk of bad jobs data, we haven't really seen much of a hit in the labor market. What we did see in the jobs data was a whole bunch of government jobs going away, and that all hitting at once. Additionally, in the last few months, the Russell has outperformed, and overall these reasonably good economic trends, a strong environment for investment into the US, and more good valuations, I am leaning toward it being a bit stronger. In the case of emerging market value, I'm still very cautious with respect to emerging markets right now, and believe that this will be quite region-specific. Yet, in this new environment, while I'm still overall quite cautious, I do believe that for reasonably priced companies, we could be seeing some very good opportunities. Now, I don't know what that will mean for indices as a whole, but even though it's quite shaky, we may start to see indications of some long-time, heavily undervalued emerging market companies starting to creep up at faster rates. So, considering that, I have to give it a slightly better rating than I had last time. Within real assets, I bumped up infrastructure to overweight, although have it in the middle of overweight and hold. And that's just because infrastructure investment, particularly government-directed and government-involved, appears to be a lot more solid right now. I'm still very cautious about there being too much hype in investments like data centers, but there does appear to be robustness in the overall infrastructure trend. I'd still veer toward caution, as there's still a bit too much uncertainty in there, and there has been some overinvestment in some areas. But the fundamentals seem pretty strong, that I'm quite confident that there will be very good opportunities, with it being a reasonably strong category as a whole. Precious metals I bumped down a little bit, and I want to caveat this. I am still holding a very large position in metals, particularly gold, silver, and platinum. However, we have seen really strong spikes downward, and though this was quite quickly remedied with a strong spike up, one that as of the time of recording seems to be parabolic, and it might warrant some caution now. In the long run, I still remain quite bullish on the metals, though expect that overall longevity will remain in gold for longer than the other metals. And overall, it looks as though we are leaving the LBMA pricing regime, and that could have enormous implications with a truly grand-scale repricing of the precious metals. However, I do tend to retain my main confidence for gold, and a few things could happen in the short term. One, we could see attacks on the markets. And additionally, just as in the case of gold, if there were some really good stabilizing event, like the end to a war, then that could end the rally for some time. I still very much like the metals, gold, and the precious metals, and anticipate that I will be holding them for a long time. But as of right now, there does appear to be some risks that some problems could creep in. Not necessarily that I'm anticipating, but am just a little bit more cautious. Personally, my base case is that we will continue to see metals rally, and I will be using synthetic long positions to get a good amount of exposure. But just want to highlight some caution. Within debt, I haven't changed much either. However, I have further downgraded US municipal bonds and developed market sovereign debt. And that's just because, as I will discuss further in the video, a lot of the problems that had already given me great pause toward these assets appear to be escalating. And I don't know if those will come to a head in the short term, the medium term. I don't really have a precise timeline on that, but they appear to be converging and getting worse. And though at the moment, I'm not calling for a collapse of sovereign bonds or a collapse of municipal debt, the caution that I had in the previous video has escalated. The financial situation in Europe in particular appears to be getting more dire. And though that isn't manifesting in anything like huge bond yield expansions, we don't see something like multiple percentage point increases in the Bund or the OAT. But that's not how these things usually go. We've seen sovereign spreads move against the French, the British, and the Germans, and move in favor of countries like Italy. Yet we have seen increased moves for capital controls. We have seen a small crisis emerge as debate raged around whether the European Union should seize Russian assets that were frozen on Euroclear. And though I can't say this definitively, just based on watching the behavior of the Europeans, I do have quite a suspicion that they may have functionally been acting as though they had those assets to begin with, using them as assumed collateral, or using them as the basis of guarantees. Now, at the same time, you have Italy asking for their gold back from the ECB. You have the ECB and the EU at large increasing talks of a centralized bond, talking even of centralized tax and spend authority, all while Christine Lagarde's Christmas message was, "We are moving forward to the next phase of the digital euro." On top of that, you have dissent across the EU, particularly from Hungary. You have the US beginning to move against the EU as well. All at the same time, internal crisis seems to be getting worse. This just makes me very weary of what is going to happen in the coming year. And when we look at US munis, muni benchmark yields haven't really had that much happen over the past year, and there doesn't seem to be any real crisis there. But they just don't make that much sense as an investment. Considering the amount of risk, and considering that there are some real risks of crisis in the United States, particularly if any social problems are exacerbated, and the internal political fighting reaches a pitch, then I'm really not so sure you're getting reasonably compensated for these things. I'd say I'm less concerned with a real acute crisis happening in US munis, but these municipalities are very often not being run very well. And when you consider that power faction conflict within the United States is escalating, all while these city governments are facing more and more problems, it just generally looks like a bad investment. Alright, little is changed on the region front. However, I have slightly ticked up South America. And this is because the Monroe Doctrine, or the Trump corollary to the Monroe Doctrine, appears to be in full force. Now, what could this mean? This could mean that there are chaotic elements while the transition occurs, but could very well also mean that there's a lot more investment from US firms, and perhaps from the government itself, particularly if there's more clear political alignment and US hegemony in the region, where the futures begin to look more certain. Then this could take away some of the priced-in risk. Now, I'm certainly not going to say that South America is going to be a non-risky region, but at the same time, when you have a number of political shifts going on in the countries, you have a US that is firmly stepping in, and much more clear geopolitical positioning, and you have a lot more talk of US investment, then while I can't say South America as a whole is a great investment, it looks as though there's going to be a lot more opportunity there, and overall I feel much better about the region. I would still certainly urge a great deal of caution, but it looks to me as though there are going to be plenty of long undervalued assets that begin showing themselves to be much more robust. For real estate, I haven't made any changes as of this report. I still tend to be quite skeptical of office investments, although I can imagine that beginning to change. I just haven't made any firm changes as of this report, but do consider it something to keep quite a close eye on, and still tend to favor storage. Hedge strategies as well are largely the same, but I've increased global macro, and that's because the global and the macro are getting a lot more crazy. I mean, we had the Japanese yen carry trade begin to break down. If somebody could have jumped on that, wow. We had these wild changes in sovereign spreads. The overall geopolitical realignment is enormous. Long-time assumptions are beginning to break down. Now, this is certainly going to be quite manager-specific, but if someone is good at global macro, now's the time. And let's look at the ideas going into 2026. One of my short essays is The Treasury is Fine, and I will have written and audio forms of the full written essay coming out soon. There has been so much talk about how the Treasury is doomed, how the world is de-dollarizing, and how it is no longer going to be the reserve asset of the world. How everyone is looking upon our fiscal position and simply saying, this is unsustainable. Let's sell the Treasury. But we haven't seen that happen. Whenever there's a slightly bad bond auction, the libertarian commentary always comes out to say, no one's buying the Treasury anymore. But what we actually see is if you move it a few basis points, it sells marvelously. So what's going on here? Well, the Treasury is not going away. Maybe some of these arguments would work if the United States were some island nation somewhere, or even if it were a reasonably sized economic power. But the United States is something quite different. The Treasury is something quite different than normal sovereign debt. It is base money in our monetary system, the global monetary system. The basis of the global credit of the world is Treasury bonds, and that's not going away. Yes, it could over some long period of time, but there will be plenty of warning signs before then. Now, people point to foreign central banks buying gold and saying, see, they no longer want the Treasury. But we really haven't seen a sell-off in the Treasury like those arguments imply. Yes, we have seen purchases of gold, but this is a fundamentally new geostrategic regime. And while we see many assets being phased out, the Treasury is not one of them. So what would actually cause people to ditch the Treasury? Well, it would have to be a fundamental geopolitical regime change, and one that looks different than what we are currently seeing. Because people don't buy the Treasury because they want that particular yield. They buy the Treasury because it makes money, because it is money. And in many cases, they buy it because they have to. Very often with contractual mandates. Say the US fiscal position were to get worse and worse, with the government going further and further into debt. People looked on the fiscal position and said this is unsustainable. Well, how would the US manage to pay back that debt? It wouldn't. What it would do is keep going further into debt. Now, it could become more sustainable by using new methods like we are currently seeing, the monetizing of the balance sheet, getting cash flows from American assets, and instead shifting the focus from something that's more income statement-like to the American balance sheet. Well, that certainly makes it look better, but that isn't ultimately what is going to drive the market. That does make things better on the fiscal end, and could much improve rates. It could be much more sustainable going forward. But ultimately, what would make it stop? Well, that would be people ceasing to buy it. The US fiscal position could, if it so chose, get worse and worse and worse. And it would just go further and further into debt. The Fed would always keep monetizing, and there would still be a market. Why? Because the demand for treasuries isn't like other assets. And there would still be buyers so long as there is a US dollar credit system. So long as the money system keeps working, people would be forced to keep buying these treasuries. So what makes it end? Is it just a pyramid forever? No, what makes it end is a fundamental regime change. It would have to be something like the collapse of an empire for that to happen. And that could certainly happen. But it's not going to happen because people look at the debt to GDP ratio and say, this is a bit above my tolerance. But even taking that worst case scenario out, we are addressing the balance sheet. And if anything, we are expanding the market for US treasuries via stablecoins, as more and more people are using US dollars in areas that had never been banked before. All of those US dollars issued as stablecoins must be backed by US treasuries. If anything, we have been seeing re-dollarization. If you were to see strain in other parts of the world, say something where you would see core EU country sovereign debt spreads worsen against other countries. Perhaps, I don't know, the German and French worsening against Italy. Or you saw something like the collapse of the yen carry trade. You might expect to see something like, I don't know, the euro rising against the yen. Well, who could imagine a situation like that? Well, in situations like that, you would expect to see US dollar against those domestic currencies drop, as domestic credit positions must be closed. And today, we see movements in the US dollar indicative of the continuance of US dollar credit. US dollar credit, which runs on the fuel of US treasuries. We have an expanding market. We have re-dollarization. And we are addressing the balance sheet side of the equation. Yes, there could be a future where the treasury ceases to be a reserve asset and it must trade as normal sovereign debt. But until then, the treasury is not a sovereign bond. It is money. Next, I like US industrials. And I like US industrials for a few reasons. One, energy is very cheap. And we have been seeing some pretty good economic growth. Economic growth around what appears to be productivity gains. Now, many have pointed to the recent jobs reports and said, look, layoffs are happening. But what we really saw was a decrease in the federal workforce. That is very, very different from industry laying off workers. With reasonable prices, good productivity, good economic growth, and a reasonable workforce position, that seems to be a quite good economic backdrop. But there's more going on than that. We see the government shifting to a very strong focus of backing US industry. We have seen government investment. We have seen policies designed to incentivize industry. We have seen foreign investment. And we have seen a prolonged campaign of deregulation and improving taxes. All the while, there are still many cheap companies in the sector, and the sector has still done quite well. Yet, so much focus has been given to tech firms that many opportunities have been left largely unrecognized within industrials. I'm certainly not leaving tech, but I am becoming more wary. And all the while, the productivity of tech, the new technologies that have been introduced into the US economy, appear to be showing benefits without the doomsaying economic disruption. So, considering the expense of tech, considering reasonably good prices within industry, and considering almost the entire government and executive branch appear geared toward backing US industry, it seems pretty good. Next, I write about Latin America, and this is a region that still requires a great degree of caution. It is a quite unstable region, but seeing the new Monroe Doctrine in force, and seeing some quite sizable political shifts domestically within Latin American countries, it's worth noting that there is some very good economic opportunity in these countries with some marvelous natural resources. As the US increases its influence and position within the region, it appears quite interested in getting American investment. Domestically, we have been seeing political shifts more favorable toward these economic opportunities as well. And particularly if this new Monroe Doctrine forces out foreign influence besides American influence, then that's a very good backdrop for investment and economic growth. So I would still be highly cautious about this region, but there do appear to be some really good opportunities on the horizon. And last, I say watch for the powder kegs. There are many geopolitical stressors that are converging all at once. There are problems economically, financially, politically, diplomatically, and overall, a whole lot appears to be converging right around the same time. It appears as though the conflicts between the power factions who want to say what the new order will be are escalating quite substantially, and I figure that a good analyst going into 2026 must be very mindful of these matters. And going back to what was said earlier, these more soft, social, diplomatic, political, these sorts of issues need to be focused on by someone who is going to trade in this style. So let's look at some of the potential powder kegs and opportunities. This certainly won't be an exhaustive list of what to look for, but these are some places that I certainly am paying a great degree of attention. Number 1, Europe's money. The Euroclear assets. The digital euro. Capital controls. Worsening spreads. The Japanese carry trade. Internal political strain and demographic crisis. And the overall contraction of EU economies, substantially weakening German industry and worsening energy output. The multi-year process of putting band-aids over the EU's financial problems appears to be reaching its limit. As we have discussed before, they really need a war or some way to engineer a reasonable collapse default, recollateralization, and reissuance of credit. They need some way to go into their new monetary regime because this one is not working. And all the while they've been unable to get their war thus far, they have been making some enormous guarantees. That all appears to be coming to a head with quite a lot of stress within Brussels. And not only Brussels, but within the EU member nations. So I'd keep a close eye on the moves that happen there, as things could get worse. And serious credit crises usually don't happen all at once. So I don't necessarily expect to see some catastrophic collapse. But watching these strains eat and eat at the European Union and pile up while the ability to put band-aids on these wounds dissipates, I'd keep a very close eye on just how drastic they are going to get. Number 2 is the Ford Carrier Group. As we discussed before when talking about Latin America and the new Monroe Doctrine, the Ford Carrier Group has tremendous power projection and has very good signals intelligence. That will be a very clear indicator of where U.S. power is focusing itself, and could also be a good indication how the White House is positioning itself with respect to other U.S. actors. There are many moving parts on the game board, but when considering the capacities of this carrier group, it's certainly something to keep an eye on when analyzing the strategic moves of the players of the new global order. Number 3 is EU instability. Talk of canceling elections is back. Sweeping new censorship regimes are in play. Talk of centralizing the debt and tax and spend authority. And as a fun holidays message from Christine Lagarde, we found out that the digital euro is going into its next phase. Meanwhile, you have massive dissent against conscription in Europe. You have farmers continuing to protest. You have the perception of EU and national government legitimacy crumbling to the floor. You have the US banning EU officials who have been involved in the censorship regime. And on top of all of that, you have collapsed societies with massive demographic problems that have led to incredible social strain and conflict. So when the French or the German ministers come out and say, you have to go off and fight Russia soon, just keep an eye how long this can actually continue to exist. And last, we have Fannie Mae and Freddie Mac, and the mortgage market as a whole. Ever since 2008, the wealth creation engine of the 30-year mortgage has collapsed. The US middle class has no longer been able to make wealth in the way it once has. That has largely removed the middle class borrower from the long end of the yield curve, or at least moved substantial influence into the foreign banks. This regime has also made it extremely difficult for a small business owner, at least one who wishes to have a reasonable tax strategy, to buy a house. The current system is engineered to keep the middle class as a set of cash cows, constantly being drained while never making any real wealth. Well, there's a fight brewing about that, and right now it is very evident that there are many powers aligned who wish to stop any change from happening. as the status quo, where the middle class is simply a consumer, tax, and fee farm, has made some people very wealthy. And the relisting of Fannie and Freddie appears to be quite pivotal to that change, as now the interests who want the middle class to be able to buy homes are moving forward with their projects, and those who do not have entrenched quite strong opposition. Now, it appears as though we will get change, but that fight is a very fierce one. So certainly keep an eye on what happens on the mortgage front, as this could fundamentally change the capitalization and the wealth of the middle class. And beyond that, it could change the pricing mechanism for the long end of the US yield curve. We could be entering a very different regime for the middle class. And one of the early moves in that fight looks poised to be what happens to Fannie Mae and Freddie Mac. Well, I will have the full written version on Substack, and I will be producing audio recordings of the full written forms of the ideas essays. But 2026 looks like it could be quite wild, and is certainly one to pay close attention to. There's a lot coming to a head, and while it could be quite alarming, this could also be one of the most rich, opportunity-dense periods of time in decades. Maybe longer. Well, do like and subscribe if you enjoyed this, and check out my other work in video and on other websites. I have links available for those on my channel page, and have a marvelous night.